Greetings to everyone. Today, we're focusing on three major companies, truly significant ones that could soon become very interesting from a portfolio perspective. We'll be combining technical and fundamental analysis to get a clear picture. Stay with me. The first of today's three Wall Street stocks that we are going to discuss in detail is Intuit, a company that, in my analysis, shows us a truly virtuous, robust, and consistent growth trend that has been sustained over the medium to long term. This is not just a short term phenomenon, but rather a pattern that has persisted and demonstrated resilience over several years. It also presents a dynamic support area, specifically this trend line, which could potentially be reached in the near future. And we are talking about the $580 to $590 per share range, which is a significant price zone for this stock. In my opinion, despite the presence of what appears to be a triple bottom area, actually, upon closer inspection, I think it's even a quadruple bottom, which is quite rare and noteworthy. This support area is unlikely to hold for long. I believe it's more probable, based on the current technical indicators and market sentiment, that we'll see a new downward leg to reach this level, possibly even breaking below it. I also illustrate this scenario based on the simple 50 and 200 period moving averages, which have just signaled what is known as a dead cross, a bearish technical signal that often precedes further declines. So we might see an attempt at a rebound from this support area, and in the short term, this support area could hold temporarily, but in my view, it's more likely that we'll then see an exhaustive downward leg as selling pressure increases. So after an initial phase of consolidation and an attempt by buyers to hold the price at this level, there would likely be a bearish move down to the next significant support zone, which could open up further downside potential for the stock. $580 to $590 per share. And for Intuit, let's use the forecaster. It has a PE that is definitely high, a PE that is certainly high. So a lower price would clearly give us a more acceptable PE. The stock is interesting because the four parameters we use to determine possible fair value currently indicate an undervaluation of 24%. It's a company that we also see posting good numbers in 2025, but in the latest report, there's a slight decline with an ROE that's below inflation, definitely good debt, and an interesting profit margin, though it has certainly dropped compared to before. There is a risk that investors may still consider it expensive, and in 6 days, the quarterly report will be released. It might be wise to wait and set a nice alert on our platform to see if the quarterly results trigger any downward movements so we can evaluate the $580 to $590 range. Intuit is definitely a very important company in its sector. As we can see, Intuit's leadership in financial software is supported by a vast integrated ecosystem with solid data insights, partnerships with accounting firms and banks that create high switching costs, proprietary machine learning models, and years of tax-specific data. This financial expertise is hard to replicate, so we have a company with its own know-how, absolutely, and clearly a company that invests heavily with a budget dedicated to research and development that is definitely higher than what is allocated to marketing. Another very interesting aspect is the consistency of subscriptions. Over 80% of their revenue comes from recurring subscriptions to their platforms and tools, which means there is a predictable cash flow with high renewal rates. So this qualitative scorecard from the forecaster gives us a very interesting snapshot that isn't easy to extract from financial statements, as I always say, which is why the forecaster software is so useful. And in the end, it gives us the highest score. So it gives us a 10 out of 10 based precisely on pricing power, research and development, and the potential future growth of the sector. So we definitely have an interesting stock here with a solid and defensible business model characterized by strong moats, recurring revenues, constant innovation, proven resilience, and so on. So it's definitely a very interesting company. And after reaching highs of $812 per share, being able to get it at $580 or $590, in my opinion, could be really, really attractive. Now let's take a look at another important stock. A very closely followed stock is Mercado Libre, and here too the support trend line is very clean and clear. However, be careful here as well, because this short-term support is at risk, in my opinion. On a break of this level, especially since we've just seen a dead cross on Mercado Libre, meaning the 50-day moving average has crossed below the 200-day moving average, this is usually a signal that since these are slow moving averages, we don't see the effects immediately. So we could see an attempt at a rebound, but it's not guaranteed, especially since Wall Street has been showing signs of weakness in recent days. If this situation triggers a medium-term bearish impulse, I believe we can't rule that out. To go and target the 1740 to 1760 area. So on this note, let's remove this and also clean up the chart by taking out the moving averages. Here we can see that if this low is broken, the next target would be the previous lows, which were precisely the April lows during the index crash in the 1750 to 1760 area. And here too, it actually becomes quite interesting because the stock was at 2006. So the 1760 area, in my opinion, is both reachable and really interesting. The company continues to see its profits increase. We'll see how strong this trend is, because at the beginning of the year, profits were at 1.9 billion and now they're at 2.5 billion. Here too, the PE ratio is definitely high. Even though over the very long term, the price to earnings ratio is going down, in my opinion. Actually, it's not just my opinion. We're fully aware that having a lower PE makes it more attractive. We always have to think about what investors see, not just what we would do ourselves. Revenue here is also in constant growth. In short, I'd say we're all very familiar with this stock without a doubt. It operates online commerce platforms in Latin America, Mercado Libre Marketplace, an automated online commerce platform that allows businesses, merchants, and individuals to list goods and to make sales and purchases online. Then there's Pago Fintech, a financial technology solutions platform that facilitates transactions both inside and outside its marketplaces. So it's a company that definitely has significant know-how of its own. Let's take a look at the growth in revenue and profits by looking at the ratios. We also see some very good numbers because the debt is equal to 26% of equity. The profit margin is not exceptional but positive, and the ROI is very good. When it comes to ROI, we always look for returns that are as much as possible above inflation, because that justifies the shareholder's return for taking a risk in a business, instead of, for example, choosing fixed income with government bonds. The Altman Z-score should be above 3, and here we basically have only positive data. Let's take a look especially at revenue growth. In 2017, it was 1.4 billion. Now we're at 24.6 billion. And also the trailing 12 months, so the last 12 months, which gives us an updated picture, financial data collected over the last 12 months. TTM financial statements provide an up-to-date view of the company's performance, still growing by 18%. So this is a stock that continues to do not just well, but very well. We have a net income of 2.5 billion, so roughly 10%, which is the minimum we want. But let's also keep in mind the research and development expenses, which are 2.1 billion, so they're almost as much as the net income after taxes. So this is definitely a very strong positive signal. So absolutely on the watch list. And I repeat, it's really about looking for, in quotes, a bargain in the 1750 to 1760 area. And let's stay on Wall Street, where we have Cintas, a company we can call old economy. In my opinion, here we already have a buy signal, because after testing this support area, it's now breaking out, breaking the relative high and low, breakout in progress. If today we get a positive open, I think that's a fairly important bullish signal, because these lows really, $180 was a well-bought low. The company was at 228, so I think here there's a restart underway. And Cintas Corporation is definitely a solid company with very low debt, good ROE, excellent profit margin. And here too, we see a company that continues to increase its revenue. and has 1.8 billion in net income on 10 billion in revenue. So about 18%. So an optimal situation, an important company with 46,000 employees. Here we are. It provides uniforms for corporate identity, so work uniforms, related business services in the United States, Canada, Latin America, support uniforms, flame-resistant clothing, so everything that has to do with a company's work, mats, mops, shop towels, and other accessory items, and so on. Keep in mind that this is clearly a classic old economy company, and very often we go and look at the overview tour, which is very convenient. Here it is. I always remind you about the 20% discount to subscribe to the Forecaster. The offer ends soon, and you have the link in the description. Now, this is a company that over 20 years, as we can see, has had price growth from $11 to $220, and we can see how earnings have always been steadily increasing. So this becomes the classic company where when the price dips or drops, it tends to be an opportunity, an interesting opportunity. And even though this company might seem to be in a business that anyone could do, it boasts a solid competitive advantage thanks to a vast vertically integrated distribution network, proprietary logistics and inventory management systems, and decades of specialized know-how in uniform rental and facility services. Competitors would face significant investments and long time frames to replicate these well-established experiences. So a truly interesting company, interesting, and it has a high predictability when it comes to recurring cash flows. About 85% of revenues come from subscription rental contracts and multi-year service agreements, ensuring high predictability and a low churn rate. In the last 5 years, both revenue and profits have grown, and the company has a score of 9 out of 10 with this artificial intelligence tool of the Forecaster terminal, which is extremely useful, really extremely useful. So in my opinion, Cintas Corporation could already offer us an interesting upward movement. Greetings to everyone. Happy trading. See you next time.